Okay. Oh, sorry, hold on a second. For some reason, I need to give access to privacy. I guess they've updated their privacy. Here we go. Okay. Okay. Great. All right, can you see my screen?
Yes.
Yeah, can you see my screen? Okay, amazing.
Yeah.
So a little bit about myself. I work with Fundie Ventures, and we do early stage consulting with social entrepreneurs like yourself. I was awarded Forbes 30 Under 30 in Spain and Europe last year, and I've been based here in Spain for about 4 years now. So what we're going to cover today is basically how to prepare for raising money. So we're going to look at your startup growth path and what some of the capital raising rounds that you can expect, how to prepare for investment, and how to find some investors. And so I know that working with Richard Billions, that means you're going from an idea to a business plan. So now we're going to be looking ahead from once you finish your work with Richard Billions, what happens next, okay? So we have, in preparing for investment, when you are working with an investor, they want to, actually, sorry, I think, okay, so we're here. You're going to basically be looking at if you are a startup that has some sort of grant element to it. You are doing some research. Let's say you're a biomedicine or a biotech firm. Typically, you can apply for grants. In which case, you have grants on the top. And this is what the items or the cash is used for. So the way to look at this chart, everything on top is the sources of funding and our funding rounds. Here on the bottom is the activities that you will be undertaking during that point in time. And this terrible looking thing here is called the Valley of Death. And it's basically the portion of your business that you'll face where you have more expenses than you have revenues coming in. So the reason why you raise capital is to bridge that gap between more expenses and less revenue until you're profitable. And so what you'll typically look like as if you're not doing a biotech or any sort of research heavy startup is we'll be starting here. So typically taking your ideas from Bridge for Billions and your business plans from there, you can go out to your friends and your family and you'll raise anywhere between $5,000 and $50,000. The idea is to get the work that you've done and try to get a proof of concept. You do a simulation or you get a working minimum viable product, and you get that so you can test it in the market. You want to also test who your target market is and really take that business plan and put it into action. The reason why we want to do that is we want to test your ideas and your assumptions that you've built in your business plan to see if those are holding true. If they do, then great, you can keep going the same course. And if not, then that's a time to make different assumptions, to try different experiments out, or to pivot altogether. So let's say your business is working, but you're burning some cash. Then you'll go to your next round of angel investors, which is anywhere between 50 and 500,000. And again, also just to put some context, these numbers are typically bigger in, or these numbers you'll see are based in the US market. In Spain and Europe, you'll typically see these numbers being a little bit smaller. So maybe 20 to 30% smaller on all of these numbers here. So as an angel investor, you're bringing in an outside investment for the first time. That's an investor that will be with you for the life of your business. And that's somebody who's there who is taking a bet on your idea, given that you've been in the market for a while. And they say, great, what you're doing is amazing. I have some skills as myself as an investor because I have experience in this marketplace. Let me help you, connect you with some people or give you some advice. So really these people are there to support you, not just financially, but typically they have market expertise to help you go along. So similar to the mentors you're working with now, while you're going through your Bridge for Billions work, this is somebody who will write you a check and help you along as you do your work. Then as you grow a little bit more, that'll be the first time you'll raise venture capital, anywhere from $500,000 to $2 million. This is, again, is early stage. This is somewhere you might, perhaps in usually a year and a half from now, once you graduate from from Bridge for Billions, you'll be looking around to raise money from venture capitalists around then, because beforehand, and we'll talk about the things that you want to talk to or the things you want to highlight when you're talking to venture capitalists, is things like traction and success and what have you done thus far. And then going forward, to grow your business even further, you raise 2 million to 50 million, and you're doing production prototypes, you're working through distribution channels, and then you may or may not have this phase. Most likely you'll not see private equity, but this is just done here for completeness. And usually you'll skip from venture capital right to either an IPO, where your company goes public, a merger in which you merge with a company of similar size for strategic reasons, or acquisition, which is the most common route of your goal is to try to sell your startup to a Google, an Apple, a Salesforce, Facebook. That's typically the route that a lot of people go towards. So before we move on, are there any other questions in terms of these sort of stages of funding and the stages of the development of your company?
Oh.
Yep. Okay, if not, then
maybe, yeah.
Yes, go for
What is if your goal is not to be like, our goal is definitely not to sell it to Google or something like that. It shall really be a social enterprise, so to definitely keep it.
Yeah, so what's interesting in the market is there are people who that's a great point. So in which case you'll need to think of an exit for your investors. If your goal is to start this business to then grow it and maintain it as a business, on an ongoing concern, then one thing that you can explain to your investors is, great, at some point around here, we want to do a management buyout, meaning the managers will raise some money.
Mm-hmm.
Typically you'll raise some debt, or you'll get together and take your personal assets, and you'll buy the company from your investors, and that way you'll actually, as a management team, own the startup itself. Because what's going on is, as you raise money, you're also giving away ownership to investors. And the typical path that entrepreneurs, the typical reason why that works for investors is they understand that at the light of the tunnel, after 8 or so years, there's going to be a sale, or the company goes public. I mean, your other alternatives, you could go public as well, in which case you would be listed on the stock market, and anybody's aunts and uncles and grandmothers and grandfathers, they can go and buy a small percentage of your company. But for these investors, you're trying to find a way for them to exit their position, meaning sell their stake in your company, so that way they can get cash back. And so this is typically what you'll find. So either your goal would then to be IPO, or you'll take on, you could be doing management buyouts if you're doing equity, or your alternatives is you could try to raise different types of capital that aren't equity. You could try to raise debt, try to look for grants, because debt and grants don't imply any ownership. In which case, it's just the money's used to scale, and then hopefully you can pay that back with the revenue of your company. Does that answer your question?
Yes, thank you.
Great, that was a great question. Thank you for that one. Are there any others?
Yes, yeah, I've got one. So as an early stage startup, what would you recommend as the right approach to look for grants, or possibly look for investment with convertible notes, maybe? What's your take on that?
Yes, that's a great question. Convertible notes will typically be issued by savvy angel investors or early stage venture capital funds. What my experience is that I have more experience with venture capital funds, and they'll typically invest in an investment vehicle they're comfortable with. Meaning, like, an investment vehicle is equity or venture debt. And I know of some that only do venture debt, because that's what they're comfortable with. And you can look at different funds, and then you can even inquire, what type of investment vehicles do you offer to startups. I know there's even I believe it's called the University Fund. I think they're based out of the Netherlands. On their website, they even they extol the praises of venture debt, and why they want to not take on so much ownership of early stage companies, because that's their value system. That's their value judgment. Yeah, I would honestly, I would not focus so much on that first, but more matching the other parts of the investors. I mean, and we'll cover that in a little bit on what types of investors you should be looking for based on what types of criteria. And then once you find that, if they're interested in investing, you can, if you have lots of different investors interested in you, then you can dictate the terms of what types of capital you want to raise, equity, venture debt, or just regular debt.
Mhm. Okay. Yeah. Thank you. Thank you.
Sure. Yeah, of course. Any others? Excuse me. All right. Well, then we'll move on a little bit. So now, preparing for investment, what kinds of things you should get ready for once you finish Bridge for Billions. So what you want to really think about is, let's take on the perspective of investors and figure out what they consider, so that way we can think about the types of questions they'll ask, the types of information they'll want to see, so we can proactively provide that. Okay. So first, when you're looking for an investor, you want somebody who's worked with ventures in the current stage of your growth. So you'll want to work with early stage investors because they'll understand the same kinds of struggles that you are dealing with. And quite frankly, if you go to a really, really large venture capital fund who doesn't work with early stage startups, they're just going to tell you no. So you can self-select a bit and look for early stage venture capital funds. Typically on their websites, it'll tell you that. It'll tell you what type of startup they're looking for, either the revenue numbers that they're looking for, or the EBITDA numbers. That's earnings before interest, tax, depreciation, and amortization. So those are kinds of things that help you triangulate the stage. Then you will want to look at an investor who understands the kind of impact you're trying to achieve. So some investors, when their fund will have a few different mandates. So they're trying to tackle the problem with education or access to education. Maybe they're trying to tackle access to financing and banking, access to clean water, or what have you. So lots of social venture capital funds will have missions they're trying to achieve. And so that's another way to triangulate if, does my startup address something that an investor is trying to achieve? And then last, you want to look at what's the track record of the investor, and have they been able to help other entrepreneurs facing similar problems that you have in the past? Again, especially in early stage capital, excuse me, you're trying to find investors that will be with you for years. And as such, just like any relationship, you want to find people who are vested in your interest, who can bring some advice and some help to the table, because you want this to be sort of a harmonious kind of thing. You want to work with them because they have a great network that helps your business, that they've got lots of experience solving the problems that you're currently facing. And because if you have the luxury of choosing any type of investor, choose the one that's best for your business. So those are the kinds of things you want to consider. And then when an investor looks at you, and trying to put on the investor's perspective for a second, they're going to be looking at the industry that you're in. So they're looking at healthcare, energy, finance, etc. They're going to be looking at the geography, so where you're based. Lots of investors will actually choose to only invest in certain markets. Developed markets, developing markets, sub-Saharan Africa, Western Europe. They'll typically have this on their websites as well. You want to look at the stage, as we mentioned before, so early growth or pre-IPO. They'll want to look at expected financial return and timing. So the reason why I say this is within startups and within the venture capital world, they typically look at how many times cash on cash they can return. So if they invest $100, how many dollars are they going to get back? If it's $200, then they've got a 2x from 100 to 200. If it's $300 that they're getting back, then that's a 3x. Putting in 100, getting out 300. They typically will have preferences depending on what type of firm they are. And it would behoove you to look into a little bit of what their expectations are. And the reason why is, I know because we're doing impact startups, we don't just care about profitability, which is a great thing and a hard thing at the same time. And that's a bit of the added triumphs and tribulations of being a social entrepreneur, is that you have to care about the finances, but you also care about making an impact. And not always, but sometimes that's an extra consideration to think about. So there are some investors who are willing to wait longer for a financial return. That's typically called patient capital. And that's because investors understood, look, we want to reward startups who are doing something really profoundly meaningful, and they're doing something good for the environment and for people. And so we're willing to wait for our return. And if you think you have a business that will be just as profitable as any normal traditional any normal enterprise, then great. Then you can look for any type of investor, venture capital investor. If you think it's going to take you a little bit more time, then try to look for, and you can even use keywords in Google for patient capital. That's just a venture capital investor or maybe a foundational investor that is willing to wait a bit longer for their returns. The next, you have the type of impact you're making. Again, as I mentioned before, each venture fund will have its own impact mission. And so you want to make sure that you're aligned with the things that they're investing in. So again, supporting women or clean technology or what have you. And then the investment vehicles you mentioned before, the debt, equity, or venture debt or SAFEs, which are standard agreements for future equity or simple agreements for future equity. And that's similar to venture debt, where venture debt, if you're not familiar, they give you debt and then that later can turn to equity. SAFE is they'll give you cash and then later on that turns to equity, depending on certain events. So those are the kinds of things that you're thinking about for making an investment. Before we move on, are there any questions with those? Those are the kinds of things that you want to be aware of, that you want to make sure that you're sort of triangulating. Okay, we have a venture capitalist who invests in my industry, who invests in my geography and does early stage, great. Now then, do they also invest in my impact theory? And then what sort of investment vehicle they have. And then once you've done that, then great, let's think about timing and return of the investment. This is a little bit more of when you get into due diligence, and they'll be asking you about exit strategies if you have any, or they'll ask you about, I mean, somebody in a venture capital fund will be doing a revenue model and doing a quick model if you get far along, and it helps to just have an idea of what you can expect, or what you can translate that to them. So are there any other questions on this slide before we move on? Okay. So once you've got your business plan, you'll want to turn that into a pitch deck, because it's the easiest way to transmit that information. Your business plans are really, really thorough, and that's great. And investors will, may want to look at that at some point. But the industry standard these days is pitch decks and financials. So when you're creating all that, the goal is to instill confidence in your startup. The better that you can build a coherent story, I'm talking about strategy, your traction, and the potential of your company. Honestly, it's easier for them to justify the investment. You'll be talking to an associate at a venture capital fund, or an angel investor, and or like a group of angel investors. And the idea is, great, if you're talking to an associate, they have to then sell that to the venture capital firm. So if you can make their job easier by making a clear strategy, a clear, history of traction, that you've had past successes, and that the potential for your startup is massive, then it's a much easier sell for them. So you want to make that sales pitch to them, so that way the first person you meet can make that sales pitch to their boss. So when you're making this pitch, you want to have a really complete story, and you want to make it simple in terms of like where the company is now, what's going to happen next, and what they can expect for, and then the steps that you need to get to where you're going next. And you want to do that in terms of the business's growth, revenues and expenses, and the impact, typically outcomes and outputs. Have you covered theory of change yet in any of your lives? Has that been something you've covered? I'm going to assume no, so that's fine. So first we'll start on the business side, and then we'll go to the impact side. So you want to create a strong business case by doing the following. Talk about your operations and how the business is making money. You want to talk about what revenue streams you're making money for. So for example, if I'm using Starbucks, just not an impact startup, I know, but if you're using Starbucks, operations would be great. We run stores to sell coffee, and our revenues is we sell coffee and we sell holiday CDs and lots of other kinds of things, and are in these stores. Then you want to think about the unit economics. Meaning, so a couple things. So first you want to look at when you sell one individual, let's say cup of coffee, you want to look at how much you're selling it for, it's your revenue. You want to look at the cost, your cost of goods sold, which is the cup of coffee, and everything that's gone into it. So that's typically the lid, the cup itself, maybe that little sleeve because it gets really hot. But that it becomes your cost of goods sold. So when you take your revenue minus your cost of goods sold, that gives you your gross profit. And investors want to know, great, after you make one sale, what percentage of that sale do you get to keep? So the higher that gross profit margin is, revenue minus cost of goods sold, the better. Then also unit economics also implies if you have a subscription service or any sort of service where it's not just one purchase and that's the end of the engagement, they'll want to look at things like customer lifetime value and they'll look at lifetime value of your customer and customer acquisition cost. I believe that's something you've learned in that you've learned at Virtual Billions in one of the modules. I believe that's something new, so you should be familiar with that. But investors, especially for software as a service companies, the SaaS models, that is something that they'll ask every time. Then they'll ask you for your margins, your operating margins and your gross margins. That gives an investor an idea of how efficient your business is at turning sales into profit. And then again, profits. Then lastly, why it's in bold is traction. They want to look at any successes you've had in the past. So if you're an early stage company and you're not in the market yet, okay, have you won any business competitions? Or have you done any pilot projects or manual simulations of, we've tested this in the market in a really limited way, but these are the results of what we found. And anything you can show to an investor, like our assumptions that we're putting behind our business model is being proven and has been proven to be successful is great, because they want to get an understanding of, we can't predict the future, but our best indication is the past. And so if you're having some past successes, then great, maybe the momentum will carry you forward. The next is the impact case. And what we're looking for there is we want to look at the target population we're serving. So is that, I guess it's both within geographies, like who are the people you're serving and what geography, and also what types of people. So is it, so we worked for, I did a project with a microfinance institution in Ethiopia. No, sorry, a microfinance institution in Ghana. And what we're looking at is they were doing small loans to women of families, because there's a lot of research that shows giving loans to women as opposed to men has a lot higher outcomes. For whatever reason, maybe the women invest more in the family or what have you, and men spend it on frivolous nonsense. I'm not sure. But so you'll want to talk about exactly who you're targeting, because that also helps the investors understand where their money is going towards and who you're trying to help at the end of the day. And also some investors and myself in particular, I know somebody who's been living in the the Northern Hemisphere by and large, at least in the Western world, we're quite further along in terms of development. And so I guess in this Buddhist principle, all life is suffering, but some problems are worse than others. Some investors like tackling more foundational problems like access to food and water and education. So you'll really want to target what type of impact and who you're helping match that up with the type of investors that you're looking for. Next is theory and change. I think have you gone through this before or no? So briefly, and it's very simple. You're going through what we're doing as a business and who and how we're helping them. So essentially, you're going from inputs, the things that the business has. So if we are so typically what I like to use for this example is a mosquito net company. And our idea is to sell mosquito nets to people who live near rivers, because having mosquito nets, if they're used properly, typically will lower malaria. So our theory changes our inputs. The things that we have is people, and mosquito nets. And then our outputs are the things that we are, or I guess, so inputs and activities. Great, we're going to make mosquito nets. Then our outputs is we have X number of mosquito nets that we've built, and we've sold it to X number of people. Then our outcomes is we're looking for hopefully people are using them and they're getting less malaria, which is a good thing. And then impact is basically a compounding effect of those outcomes, right? If you don't get malaria today, then maybe that means you aren't skipping, you're not missing school or missing work. And so hopefully your life is getting better in some ways. And so you'll look for ways to track that. You might say days of schools missed is a proxy for that. You know, the fewer days of schools missed, then that's great. You're going to have a better life outcome. Or the average revenue or the average income of a family. That might be a proxy for your impact. But you have to basically measure outputs to get to your impact. And that was not a great explanation, but long story short is that's something that you will want to be able to enumerate in a clear and concise way, because that's basically the reason why your business exists. It's what are we doing as a business and how is that going to affect our consumers or our beneficiaries? Then we want to think about the unit of change, primarily meaning if we have, if we're looking at our outputs, right? The number of things that, or the number of days not missed at school, or the, you know, what are we defining in terms of that output? So if we're looking at, again, this example, it might be the great salaries are increasing, or the local, the households are, you know, winning more money. So there's an assumption that more money equals a, you know, great opportunity, going from your outputs to your impact. Then we want to think of outputs versus outcome, meaning outputs is the volume that you are, you know, the number of mosquito nets that we're building, versus outcomes of the number of people that are having more money or less days of schools as a portion of that. And the reason why is if let's say we have 100 mosquito nets that are being deployed or sold, and then we can look at the outcomes and compare how effective our outputs, you know, giving people's mosquito nets, is that how much does that translate to fewer days of school missed. And then lastly, traction. Anything that we can explain of that we're in the market, we've helped people, or even in these pilot projects, we've been able to help people in a meaningful way, and that these outcomes will hopefully then lead to impact is brilliant. Because again, just like the investors want to look at, are you going to be profitable in the future, and does this business make sense from a business side? They're going to ask the same question, like, is this actually going to be meaningful in terms of impact? Great. Are there any questions on that? Okay, great. So the way to do that and what the actual materials you're going to have is, to build credibility, is first you want solid financial statements. You're typically projecting 3 to 5 years. Everybody knows, myself included, that when you're doing financial statements and you're looking 3 to 5 years in the future, those numbers don't really, they're not going to be what actually happens. But the reason why people want to see that is when you build a financial model, you are building lots of assumptions. And let's say we look at revenue. The revenue is how much money we are getting in, or, you know, coming to the business. But that's because the number of sales and the number of sales we have and the price we're selling it at. And so both of those are assumptions that people are willing to pay, let's say $5 for whatever we're selling, and we're assuming 100 people. And so $5 and 100 people gives us a revenue of 500. And so we want to look at those assumptions to test, is the pathway forward that you're thinking and that you're assuming, are those defensible assumptions? And so we want to understand, do you understand your business? Do you understand how your revenues, you know, what are the biggest drivers to your revenue? What are your biggest cost centers? Things like, you know, will you be able to make enough revenue to cover, you know, your salary, your rent, those kinds of things. Then we want to look at your business model, which is what you're building now, is how you're going to make money. What are those different revenue streams, and what do those look like, and the assumptions behind those. Key assumptions you're making in that model. So if you're selling cups of coffee, then one assumption is people want coffee, right? And that's something you're validating right now while you're building your business plan. And then the things that you want to be really honest about is what concerns you the most. What sort of things are you worried about? Because investors will likely have the same concerns as well, and what you're going to do about that. If you can be like, if you get to a good investor, they'll do due diligence on you, which basically they'll open up the company, they'll look inside, and they're going to find most likely everything because they're putting money in with you for the next, 5, 6, 7 years. So if you can tell them and be honest with them and saying, well, look, we're worried about this. We know this is a problem that we need to solve, but at least we know about it, and we're going to find a way to mitigate that in the future. And then lastly, what levers are critical to your business? Meaning, if you have a low margin business, meaning the sales minus expenses is very low at the end, your profit's low, then one of those levers is you have to make lots of sales, right? And you're going to be a high volume type of business. If you're selling a luxury good or some luxury product like upcycled sweaters made out of recycled plastic, okay, great. You can sell a higher price because there's that added perception of value, in which case you don't have to make as many sales. But those kinds of things, I know it's a little bit daunting when you do it, but it's honestly a really great exercise to learn more about how your business will make money and will hopefully be sustainable both financially and impactfully. And then next one was have a clear understanding of what your needs are. Do you need to hire key people for the business? Do you need a machine to transform raw inputs into your product? They want to know sort of what are these things that are limiting you, and hopefully the idea is you can throw cash at the problem and solve it with investors' money. So it's either hiring new talent or hiring key people, building needing assets or money for sales activities, those kinds of things. Then you want to include the plan forward of like how we want to grow. And what's really helpful, because I think it's a really valuable exercise as an entrepreneur to understand, okay, here we are at our present day, where do we want to go, and what are the chunks or the incremental steps we need in order to get there. And so it helps you in terms of like a thinking exercise for this business and strategy. It helps you understand, how do I get from instead of from here to this really large goal, how can I incrementally get there, and what kinds of things do I need? So if I'm a company and my biggest lever is a sales team, then first is I need to hire the first salesperson or the 2 salespeople, and then from there there's a bit of time that we need for them to actually make some sales. But like those kinds of things. And after that, maybe if you have enough sales, you'll need to hire some people for support, and you'll have to build out a support team. But just having an idea of what you'll need really will help you as a business, but also will help entrepreneurs know that, great, you've looked into the future and you've got a really great sense of what your plan is forward. So a couple of things in terms of the business case, there are a lot. And so you can refer to the slide later. But product viability, what attributes are you of your product or service make it viable? Meaning, if what makes the value of it higher than the cost to produce it. So basically here we're talking about the unique selling point or the value proposition. Then market knowledge, what is the potential and addressable market for your business? How large of a market can you sell to? Your customer demands, how well do you understand your customers? Are you choosing the right target customers for your product? And something just for you to understand and think through is, does your product cause a customer to change their behavior? Meaning, going back to the mosquito company, and the reason why I like using mosquito companies, there are lots of assumptions that it should work, but if people don't use it, then there's not really any impact, right? If lots of people have shown that those are also act as great fishing nets. And so the assumption from selling fishing nets to people, or sorry, selling mosquito nets to people actually breaks down, and that those get turned into fishing nets. This is a great segue into this idea of, does the thing you're selling cause a consumer to have to change their behavior? Does it have to, do they have to learn how a mosquito net works and how to deploy, use it effectively? Or is it something they already understand and it's great? It's just another thing that you're tapping into behavior that they already know. So if you're building an app, great. people know how to download and use apps. It's not like you're creating the very first app in existence and have to explain and educate your customers on how do apps work. So next, again, you want to look at the unit model. What is your unit model of revenue minus cost, and then the profit you get from each widget or each thing you're selling, and how many things do you have to sell in order to break even? And then any barriers or ramps to the project. So what are big things that are going to keep you from scaling, and what are the biggest problems that you have to solve? Right. So one ramp might be, great, we have to do business to business sales, which means we have to do we need to hire salespeople, and then sales cycles might take a long time. If we're selling to corporates, that might be a little bit faster than if we're selling directly to schools or to governments, because governments and schools have approval processes, in which case that will make that sale take a lot longer of time. But investors will want you to know that. And so that you're accounting for that and knowing that, great, if we start talking to a school now, it's going to take a full year till we close that sale, or however long we think it will to close that sale. Next, we want to look at capacities. What organizational capacities do you have to build? Are you a blockchain company without a chief technology officer? That's somebody you'll have to hire. What kinds of things do you currently have, and what sort of things will you need to bring on with the capital you're going to raise? And then next, monitoring. So how are you going to monitor your progress? What key performance indicators are you looking for? Is it number of customers? Is it sales? Is it, there are some interesting ways to measure that. Particularly if you look at a book called Lean Startup Methodology, they talk about some really great ways to do cohort analysis, where you're measuring like 1 month of customers against the second month of customers, and has the sales or customer acquisition costs, like have those improved or worsened, as opposed to looking at total, like, great, how many customers do we have across these 2 years? So if you're interested in that, that's a great book, and there's lots of summaries, so you don't have to read a 200-page book to, that could be just as well done as a 15-page summary or 15-minute summary. And then lastly, what's your clear goals and systems? Where do you want to go, and what are those targets? Then next, let's talk about the impact case. So what's your mission statement, right? It's going to capture the impact you're trying to create. So why does your company exist? What's it trying to do? The next, you want to create an impact story, which is a little bit of a more detailed version of the mission statement. Basically, how does your solution fix the problem, or help to fix the problem? The reason being is all companies have visions and mission statements, and we want an impact story because that's an easy way to translate that into like an elevator pitch. If you're stuck in an elevator with somebody who might be interested, great, tell them your impact story. Like, we're trying to do X because why people have this problem, and this is how it's solved. Then your theory of change. Again, we covered that briefly, but why do you think your business's activities will help, will actually help people in the long run? Again, any key performance indicators. So, what are the ultimate outcomes you're trying to achieve? One, for like microfinance institutions, they'll typically look at the number of loans that they're giving, and the time that their loanees actually take out loans. Because one of their theories is, great, let's give some people access to money now, and then let's say they take 1 or 2 or 3 loans out. The idea is, hopefully their source of income is now sustainable, where they don't need loans anymore, and they're not caught in the cycle of needing to take on debt to keep their lives sort of going forward. So they'll want to look at the number of people they're helping in terms of the number of loans, but they'll also want to look at, okay, the majority of the people who take out loans with us only need 3 loan cycles before they're off debt, and they're financially viable or sustainable, or they're able to live without having to take out any debt. Okay, so were there any questions on those before we move on? We're going to move to measuring impact next.
Yeah, I do have a question. Is like, if I understood it, like in the theory of change, there you explain your impact story, right? And part of your mission.
Exactly. The impact story is a bit of a tight summary of your theory of change.
Okay.
Exactly. And the theory of change helps you It's a bit like a financial model helps you understand the finances of a company. Your theory of change helps you understand what all of your assumptions are that will end up helping people. A key assumption is like, if I sell mosquito nets to people, a big assumption is they're going to use my mosquito net as a mosquito net, and they're not going to use it as a fishing net. And that's, I mean, there've been lots of, and the reason why that's important is there's lots of examples of times when key assumptions like that have broken down. I think some big tech company was giving laptops to, I think, sub-Saharan Africa. The problem is they didn't have any way to charge it, so it just ended up becoming technical waste, or like tech waste, like e-waste, which is not a great intervention. Which is not like, but the key assumption is that local population knows how to use computers, right? There's a bit of a learning curve if you've never seen a computer before, or B, do they have, or if you even if you have, do you have a way to charge your laptop? And if not, great, you've got a massive paperweight. It's this like unuseful thing. So yeah, theory of change, once you go through that sort of granularly, you can use that to write your impact story.
So like a little bit like connecting it with the golden circle of Simon Sinek of the why and the how and the what. Could be like
Yeah.
the final impact is the why of the business, and then like maybe the output could be like the what that could change, or the theory of change is like a whole process of one thing.
If I had to map that onto there, no, that's a great one, and I use that typically for business, like when you're enumerating the value proposition. I think the what is going to be, I think the why is your mission statement. The what becomes your, I think the how and the what becomes your theory of change, and the why becomes your mission statement.
Okay, perfect.
Yeah. Good question. I really like that framework. Any others?
When you were speaking about the growth plan, I was wondering, should there be like a duration for your growth plan? Like, should it be maybe 10 years or 5 years or?
Yeah, so that's a great question. You can, you would typically, what I've seen in really good instances is I've seen two different timelines. I've seen, our biggest timeline of where do we want to achieve, what do we want to do in like 5 years? Because a lot of times the business that you start out doing is not, like it's stepping stones to get to the ultimate goal. So if the case is you have in 5 years, your startup is going to look very different from what it does today, great. Explain that. Explain like, this is the timeline of, we want to go from, let's say we want to be a big data business, right? We want to sell cell phones to people, and that's our entry to collecting data. And then, great, we'll sell cell phones, and then in 5 years' time, we'll have enough data to sell on to data purchasers. And then we want to make sure that where investors know where we're headed. And then, so that's one thing. And then in terms of raising money, we would do a much shorter term growth plan. And it would typically be from where we are today in terms of maybe, I like seeing 3 years, anywhere 3 to 5 years, because that's what the typical financial plan people will ask for. And then anything more granular than that, if you want to be really, really savvy, you can say, okay, typically when you raise money, you're trying to raise enough money to satisfy your business's needs for about 1.5 years, like 18 months. So what you can do is map your 18 months across what you want to do with that money. And you say, okay, look, we're trying to raise, actually, let me just go back here really quickly. We're trying to raise $50,000. And let's say $50,000, okay, that will probably get you 6 months, right? But when you raise for an early stage venture capital, you want to raise for about 18 months of money. So for, let's say for either friends or family or angels, you raise about 50,000. Say, cool, we think that 50,000, given how much money we're spending every month, will last us 6 months. Here's our plan for 6 months. And then in let's say year 5, we're going to start raising. Or sorry, in month 5, we'll start raising. And then month 6 to month 12, this is what we plan to do with new money. Yeah. Does that answer your question? Yeah, good. All right, let's plow ahead, go to the front here. Okay. So measuring impact has anybody tried to do that before? Has anybody attempted that? Just curious. I'm gonna take those silences as a no. It's not easy. There's some really, really brilliant people trying to do it. And I personally think that there are some really good solutions out there. I know people are of two minds of like, we're getting there, and some's like, we're not yet there yet, or what we have is complete crap. I don't think it's crap, but I think we're definitely closer than where we were. I really like this framework. GIN is the Global Impact Investing Network. They created something called the IRIS, International Reporting and Investment Standards. I think don't quote me on that, but I'm fairly sure that's what it stands for. Then they created a new version of that called IRIS Plus. IRIS used to be just a dictionary of, or just a dictionary, but essentially a dictionary of performance metrics like social, environmental, and financial success. So in IRIS, they would have something called, like if you were a microfinance institution, you would look at metrics that you can measure as a microfinance institution. Number of loans, the size of your loan portfolio, the average time to getting off the loan cycle. What's cool and what's great is IRIS Plus came out, I believe, this past year, and they've taken lots of these different measurement standards. There's Y Analytics has one, B Corp, Impact Measurement Project, we'll talk about that in a second. They've kind of brought everything in so you can use them, and they've thought about all the other measurement standards. In my opinion, it's the most powerful, and that's what I use. It's great. They talk about Nesta, which we'll talk in a second. They talk about Impact Measurement Project. They're brilliant. I applaud their efforts. They've done, I think, of the 17 SDGs, they've finished 8 because the work that they've done, when you see it, it's actually super comprehensive. You can actually tie your impact and what you're trying to do to research, like university published research, to show that your impact is actually backed by research. And it's just, honestly, it's so brilliant. So check it out. It's free. It's a public good that they built because they believe in this. So go use that. Then one of the things that is inside to help explain, yeah.
Can we get a link to access that?
Sure. It's do I not? Let's see. Yeah, let's do that right now. It's I think it's iris.thegin.org. That's the one, and I can drop it on here. Chat. I guess not. Copy, paste, and I'll put it in the slide as well. But if you just sign up for, you can sign up for a free account. It's honestly, it's brilliant. It's so easy to use. Cool. Yeah, so I would just dig it. It's like, honestly, it's dummy proof. They've done such a great job. I cannot praise them more. You can't underpraise them. Okay, so there's that. Then one of the concepts that they brought in as well is the impact management project. This was a project put together by 70 different organizations. GIN, the GSG, I believe Acumen took part in it, Tideline. It's a lot. So you can check out the impact management project. Essentially, it's a collaborative framework for understanding and communicating impact goals and performance. That's a long-winded way to say what are the things we're helping and how we're doing it. So they built 5 different dimensions of impact. I really like how they broke it up, because the goal about impact and measurement is trying to standardize it. So the same way we now in finance, we have standard measures of risk. Back in the 50s, we didn't know how to quantify risk, and now we do. We use statistics and variability, and typically we use covariance and beta. Anyway, long-winded thing for finance, but here in impact we've got the what, the how much, the who, contribution, risk. So what are the outcomes, or what outcomes does the effect relate to, and how important are they to the people or the planet experiencing? So this is kind of like how big is the problem, right? Or what is the problem that we're solving? Are they important positive outcomes, neutral, important negative outcomes? Then we've got the how much. How Like how much are we helping them? How profound is the help? And how quickly are they getting it? So deep effect, meaning these are hugely life transformational things, or marginal is like, okay, cool, I've got an extra app on my phone. Then are we helping a lot of people or a few? Is this a long-term help that we see that will, again, profoundly change their lives? Or is this just something like a Band-Aid? Is this like surgery or a Band-Aid kind of thing? And then how quickly does this change happen? Is this something that will happen quickly or slowly? And I think I really like this. They've really taken the time to think through the different sort of qualities of the type of help you might be helping people with. Then the next is who. So who's experiencing the effects and how underserved are they in relation to the outcome? Again, well served. Honestly, the developed markets have lots of things going for them, and from one man's opinion to another, it seems like it's more of a problem of resource distribution than it is like resource distribution and policy than it is like people being underserved. But hey, there's lots of impact investors in the U.S., and I don't want to discount what they're doing. But there's so many underserved markets in the world, and so that's also, I mean, at least in my view, and I think it's better to serve underserved people than well-served. But again, another thing to look through. Then contribution, meaning how does the effect compare and contribute to what is likely to occur anyway? Meaning if you didn't do anything and people's lives got better, then great, your intervention didn't really have to exist. But if you didn't do anything and people's lives didn't improve, then okay, great, then you're actually making an impact. It's sort of like this idea that all tides or rising tides lift all ships, right? If the growing economy in Cambodia is just helping everybody, then great, maybe your impact might have occurred regardless of your business. And so what you can do is use control groups and experimental groups, the customers that you have that are using your product or service, and you can use those to compare. And we'll actually look at that in a second in terms of evidence for impact. There's another framework for that as well. And lastly is risk. So what are the risk factors significant, and how likely is that to affect the outcome of what then from what you're expecting? And there's lots of different risk factors. If you go to impact management, I don't know their website offhand, but they've got a really great search engine results. So if you just type in impact management project, they've got their whole, I think it's 12 or 15 risk factors. Things like adoption risk, execution risk, those kinds of things. So if you have a look there, that'll help you think through the kinds of things that you should also worry about mitigating and worrying about making sure those don't happen. So that's the first framework that you'll see in IRIS. Another framework you'll see is the standards of evidence. Here's a graph I've just put in bullet points. When you go from level 1, you have less evidence. Level 5, you've got lots of evidence. And the idea is there's certain there's certain investors who really want to see some rigorous evidence that your solution exists, and there are others who just kind of want to, feel good about what they're doing and are, that's great as well. They're giving money towards people who are trying to do something good. So what's cool about this is you'll also have nested standards for if the impact measurements will on IRIS. So on this one, you'll have both the IMP, the impact management project included, and Nesta's evidence. So honestly, they've done such a good job. So the first level is, can you describe what you do, why it matters, and does that make sense? Is that logical? Are you saying that coherently and convincingly? And for every sort of level, they all build on each other, right? If you can't describe what you're doing and why it matters, then either I don't think then the business, you may not understand your business well enough, or you may not have thought through it well enough. But because you are all doing bits for billions, you should be able to do number 1. Then number 2, you want to capture data that shows positive change. Again, here you're looking at more correlation than causation. You want to see, is there data out there that can help suggest what we're doing is helpful? So for example, if your theory of change is we want we want schoolgirls to miss less school when they get their menstruation cycle every month, because there's a lot of evidence showing school helps you. There's also a lot of economic, like the solo growth model and that kind of thing. Lots of data showing more school equals better life outcomes. So if you can point to that and then say, great, our solution is saying we're going to help young women miss less school. Therefore, they should be having better life outcomes because they're going to go to school more. Also, that's surprisingly like a much bigger problem than people would think, especially men who don't have that problem. And that's just that's like an easy way to say, cool, here's our problem, and we know the problem. We know why there's a connection between like life outcomes and education. So great, then we can make it an assumption. Then you have a demonstration. You can demonstrate causality using a controller comparison group. Here again, we're talking a bit more of experimental in this case. So we can say, here are the people that we didn't sell to. Here are the people we sold to. What was the difference? Then after you've done that, can you get somebody to independently replicate what you've done? Again, this is just following the same thing as the scientific method. You want to post your findings out there, see if other people can replicate it based off of the same procedure. So a little bit of high school science maybe coming back to you. And then lastly, you have materials, systems, procedures. You have everything in place to make sure what you're doing is consistent. The same way, if you're Starbucks and you have the very first shop, you need to expand that to other Starbucks around the world. And you want to make sure the Starbucks coffee in Seattle is going to be the same cup of coffee, or as close to possible as the Starbucks cup of coffee in Madrid. So what sort of manuals you have in place to make sure that instead of cups of coffee, we're talking about impact and your product, making sure that you can replicate those at scale and those continue to have positive impacts. Great. So any questions on there? We're almost done. Maybe about 5 more minutes. But any questions up to where we stopped thus far? Okay. So next, the section you've all been waiting for: how do we find investors? So you want to look at different types of investors and match up your startup with their needs. So high net worth individuals and angels. High net worth individuals is another fancy word for really rich people, and they've got enough money to take risks on investing in startups. So you'll typically see them in your business earlier on, as we mentioned before. So after family and friends, then you'll look at your angels. Family and friends, they are the people who trust you the most. They think you've got a good idea. You don't have anything, you don't have a company in the market yet. So they're just gonna, if you've been a good son or daughter or niece or nephew, maybe they'll give you some money to go follow your dreams. Then family offices, that's just typically when a family has more than $100 million, they'll hire a professional manager to manage it for them. And some of those invest in startups. You can also, you can look at development banks as well. So in Europe, we've got the EIB, European Investment Bank. In Spain, it's Cofidis. It's Sofid in Portugal, the CDC in the UK. You can look at your respective development banks, and they'll typically on the website somewhere, if you dig in deep enough, they'll show you, or they'll tell you what types of things they're willing to invest in. I know the European Investment Bank, for example, in the company that we work with, writes grants on behalf of startups, because the European Investment Bank has a grant call. Every 3 months, they'll ask, are there technology companies out there that are trying to solve the UN SDGs, the Sustainable Development Goals? And if so, we would like to help you out and apply for this grant, and we'll give you free money. So if you're a tech company trying to address an SDG, there might be grant money out there for you. Foundations, similarly, foundations typically will do grants if that's part of their impact mission. Corporations, part of their corporate social responsibility is sometimes investing in accelerator programs, or they'll invest in things like along those lines. Corporate venture capital firms as well might be a route. If you have like a food tech company, maybe, I can't say off the top of my head, but I think like Nestle or Coca-Cola might have a venture capital fund themselves, and you could apply for that. That also takes us separately to a quick aside, is there's a new trend in sort of this thing called ethical exits, like trying to sell your company to a ethical parent company because you want to maintain your impact. So a brilliant case was the Body Shop, right? When they were a standalone company, they existed to produce ethical hand creams and lotions and body products. And they did that for a while, and it was great. And then they wanted to get, they wanted to sell their company. So they ended up selling it to L'Oreal. However, L'Oreal, I believe, I heard that they test on animals, and they don't have the same ethical standards that the Body Shop did. That turned off a lot of customers because customers understood, like, we buy Body Shop products because they have such a high ethical standard. We don't want that ethical standard to be diluted or to be worsened or less restrictive because now L'Oreal owns it. So there's this whole idea of a lot of interesting, really good impact investment banks that are helping social startups sell to ethical buyers. So there's a brief aside for there. Investment funds, typically institutional investment funds like endowment funds from schools or hedge funds will some of the strategy might be that. Again, institutional investors and banks. Those are all different types of players. Typically, you'll be looking first, once you finish Richard Billions, you look at family and friends, and then perhaps angels. And then when you get, farther enough along, you're typically looking at venture capital if you're looking to scale. Yes. So in terms of finding investors, here's some resources you can actually use that will help. So Impact Alpha is an online newspaper. They're just like the Financial Times or the Wall Street Journal. However, they only cover impact investing news. We cover it across impact sectors, so finance and renewables, that kind of thing. They also cover it across different theories of change, so gender investing, climate finance. So quite clever. And with that, they have a tool called the Impact Space. So it's a list of, it's a bit like Crunchbase if you're familiar with that. It talks about who was sold to who and where's the money going. They also help build this thing called the Impact Investing Map, which is brilliant. It's a visual map to show you who are some of the investors that are out there. Andy, they have a website called andy.force.com. Again, it's a lot of investors that are listed there. Angels.co is AngelList. You can find a lot of players on there as well. And then lastly, you've got impactassets.org. What they do is they list the 50 largest impact investors and impact investing funds in the world. And what's nice is they actually break it out in terms of where they're investing in, like which geography, what types of solutions they're investing in, which investment vehicles like debt, equity, venture debt they're typically using. So those are some really clever ways to go about it to try to source source your investors. There was another one that just came to mind, but I can't remember what it was. But honestly, a lot of it is Googling and figuring out, great, does this company that I found, do they meet my geography, my impact, my stage of company? It's a lot of triangulation. These resources will get you on a good start to look for those. And yeah, a lot of it is just finding those startups and matching that back to your startup. So with that, that's all I have for you today. If you have any questions, please, the floor is yours.
Hi, I have another question.
Yeah, go for it.
When you get like an angel investor or someone who's interested in investing in you, then how do you know the percentage of the startup that you have to establish more or less, like for that transaction?
Yes, that is a great question. The realistic way you do it is you start with the money that you need, and you say, okay, for just easy numbers, let's say you need $10,000, and then so that's the amount of money that you need, and that's the angel investors considering, okay, is that a lot of money or a little bit of money, or how much money am I willing to risk? So cool, say they're okay with $10,000. Then you need to you as the entrepreneur need to decide what percent of your company are you willing to give up. Typically, it's anywhere between 10 and 20%. I recently, just like last week, read that the industry average for normal venture capital is like 15%. So you're giving away 15% for the first amount of money. And when you do, if you do, let's say, if you're taking $10,000, that's what you're giving them, or that's what they're giving you, right? And then they're taking 15%. So that means you're 0.15. That means you are now valuing your startup at that doesn't make sense. The money in divided by the percentage should, oh, right, that makes sense. It should be, you're valuing your startup at 666,000, which is not a lot. For early stage startups, you might see something like 200,000 as your valuation, because really there are three things you triangulate, and you're doing a bit of algebra. It's the money that you're raising, the percentage that you're giving away, and the valuation. So if you start from the point of saying, we think our company's worth $200,000, right? And then we need, let's say we need $20,000. Great. We're giving away $20,000. Okay, we're giving away 10% of our business.
Okay.
And I've seen a lot of people do that 10% mark. You know, they do the 1 to 10 ratio of, great, whatever we raise in money, we'll give away 10%, and that's this their valuation. Does that math make sense? I hope that makes sense.
Yep.
Yep. So a lot of times you're really just determining in a real world kind of way. You figure out how much you need to raise, and your financial plan will help you do that. And then you need to determine and try to negotiate how much equity you're giving away. So you'll know this number. You'll know, like, okay, we do actually need, let's say you need 50,000. You actually need that. And then you'll talk to the investor and be like, okay, cool, we'll give you 10% of the business. And then that automatically says you've got a valuation of $500,000. And they're going to say, that's crazy. Your company's not worth $500,000. I want 20% of the business. And then that's a little bit more realistic of, okay, now your valuation is $250,000.
Okay.
Like that's kind of how that negotiation will work. Typically, when you're negotiating, you're also thinking, you'll be saying this number. You wouldn't be saying, or you would essentially say, we don't want our valuation to be $500,000. Let's meet in the middle and say it's 300 and 300,000 or 333,000, and then that will imply that. Sorry, it's just a bunch of math that you get good at over time, and I'm not good at it because my mental math is such. Basically, right, 50,000 divided by 300,000. Hello, buddy. Is you're giving away, okay, we're giving away 16% of the business. All right, everybody's comfortable with that, then great. You get 50,000, they get 16% of your business, and your company is now worth 300,000.
Okay.
Andrew, just quickly, what about a tech company? Surely they're valued slightly higher than a traditional company.
Yes, they do. So what you can do is, okay, the problem is with a tech company, you're going to have a load of potential, but you are also pre-revenue when you're starting out now, I'm assuming. And so there's a bunch of different methods to do pre-valuation, or let me see if I can find it actually. I believe Cooley-Go. Cooley-Go valuation startups. They have this brilliant blog post. And I wonder if I can find it quickly. Anyway, if you type in Cooley-Go, and I can pass it along to Bridge for Billions later, there's a bunch of different ways to do the early stage valuation. You've got the Burkus method, where you are essentially adding $250,000, depending on 5 different factors. I think those factors are the idea, the team. All right, so you've got the idea, the team, the product. I forget what those are, but as each one of those is a positive, you are adding $250,000. Then there's also the risk factor summation method. You can also do a revenue model and then times that by an EBITDA multiple. I'm sorry, I'm getting a bit financy here, but that's what you would do. You would project you would do your 3 to 5 year projections. Then you would calculate something called free cash flow. And that's just taking your earnings before interest and tax, your EBIT, this guy here. And then you're making some adjustments for cash going in and out of the business until you get free cash flow. And then you've got free cash flow from year 1 through year 5. Then you discount that back by your WACC, and then you times the last year by your by the EBITDA multiple of like EBITDA divided by enterprise value. So it's kind of like the concepts are not hard. It's just like it's a concept stacked on each other. So it's like the equivalent of learning how to do exponents without knowing how to add yet. And then, yeah, so if you have a friend who can do this, amazing. Valuations are not that hard, but it's just like it's a skill that needs to be acquired. You can use other ones, but probably the best bet for a tech company is using this. It's called an exit multiple.
Okay.
And so you've got, when you're doing that, you want to use an exit multiple. The reason why is because that's going to show you what the market is pricing companies like yours at. So EBITDA is earnings, again, basically your company's earnings divided by what companies, or they're looking at, okay, you're looking at the typical earnings of companies that are similar to yours in the market, like public companies, dividing by what those companies are worth. Or I think it's actually, I'm sorry, it's EV to EBITDA. That's the way it works. So you'll get a multiple. Say when you do the enterprise value of $1 million divided by an EBITDA of 100,000, great. Then our EV to EBITDA is 10. Then you're going to take your free cash flow of the last year, of year 5, and multiply it by 10 in year N. And then this is where you're going to get the value from the fact that your company is a startup that's in a tech thing. Because like you said, the industry matters. If you're a blockchain company, if you're a SaaS-based business, investors are way more willing to pay for those companies because they've got tons of potential to scale. So that'll be a really good way for you to argue a higher valuation based off of what the multiple is in the market. And that multiple typically for startups, we're looking at enterprise value over EBITDA.
Okay. Yeah, that makes
I'm
sense.
sorry. I know that was. I hope that was straight. If you know a little bit of finance, that makes sense. If not, it's just lots of concepts built on each other. Like knowing what enterprise value is or EBITDA is. That's a bit of accounting.
Is there maybe a tool or something that could help kind of put it all together?
There is a tool. I don't know if they do valuations, but there's a really great tool by the Case Center at Duke University. They built an amazing toolkit for entrepreneurs. And in that, it talks a lot about what we covered, like triangulating investors, figuring out, matching investors. And then it does a lot of the more nitty-gritty stuff of how do I model revenue? How do I model my fixed costs, my variable costs? And once you model those things out, it'll do the financial statements for you. So you don't have to build income statement, balance sheet, cash flow statement. It'll just do it for you. It's honestly, it's such a brilliant tool. I forget the price on that. It is not for free, but I know they do like sales near the end of the year or something like that, like an end of the year holiday sale. But honestly, it's great. They've spent so much time on it. You can tell by the quality of the material that it is. So that's quite helpful. And then for valuations, you can Google. I think I would have to imagine somebody has built a template to do valuations. There's just so many people on the planet that the probability of that happening is pretty high.
Yeah.
Yeah.
I think.
Yeah, but it's the same thing. Like if you Google Bridge for Billions, there's lots of other less qualified or less good. I love Bridge for Billions. I've done a mentorship as well, but there are other online incubators in I think based in this US. So you'll likely be to find enough materials Googling to find how to do like a defensible valuation.
Great.
Great question. Yeah. Any other questions?
Okay. Thank you all so much for joining. We've gone a bit beyond that time, but I know it was so worth it. Thank you so much, Andrew, for taking the time to go into details and teach us all this mathematics.
Sure.
Yeah, I think it's very helpful even for me. And yeah, I'm taking note of all the links that you shared as well. So I'm going to share this in the community so that all those who missed out on this can have something to refer to. So thank you.
Great.
Thank everyone for coming. I believe I mean, I can really see how developing your business plan through Bridge Pavilions will be helpful in preparing you for investment. So this is really great. So thank you so much. And I hope to see you at our next masterclass next week. Thank you, Andrew.
Thank you.
Thank you.
Okay.
Thank
have a
you.
good-
Andrew. Thanks.
Thank you very
have a
much.
good evening. Bye.
Bye.
All right. Cheers.